Good morning, everybody. Thank you for joining us for today's early reinforcement of concepts session. Good morning, Jim.
Good morning. Good morning.
Okay, so for those of you who are new or not quite understanding what is a reinforcement of concept session, basically, we'd like for you to ask any clarification questions you have on yesterday's presentations or concepts that we covered. We know that, it can take several iterations to try to understand a concept. And so if there were things yesterday that you didn't understand that we had gone over, now is the time to ask so that we can try to get that clarified for you.
The problem with these sessions is too many of you that, have some knowledge want to jump ahead. Remember, this is really concentrated on what we talked about yesterday, even though we did get off track and cover some unusual things. But we'll try and keep that in mind as you ask your questions, okay? Fire up, Jen.
Okay, let's see here. Okay, question on excess. Is it any single print that is over two TPOs?
It's 2 TPOs represents excess. Now, as Jen will tell you, that's the minimal. So 2 TPOs, means excess. Of course, then it's better to have 4 or 5 TPOs. That's better excess. Then you go to another extreme. If all of a sudden you have 15 ticks of excess, now you have to question, wait a minute, is it too much? And sometimes when you get short covering or long liquidation, so as you work with us and as you work with the market and with the profile, these things will fall into place. So we start with a basic definition. The basic definition is 2 ticks qualifies.
Let me just, I'm gonna show my screen just to the slides from yesterday so that people have.
Okay.
1 second. Okay. So here was an example from yesterday's presentation on excess. Just so you've got that.
Okay. So again, as you work with this, you start with a basic concept. And then remember, we said it's art, not science. And also what is very important to be a successful trader is as you learn it, your imagination then starts to be able to have a better and deeper understanding of what the excess is. So as I said, 2 ticks excess is minor. You get 15 ticks of excess, that's somewhat excessive. 4, 5, 6, is a little healthier. But again, there's no absolute rules to any of this. Okay?
Okay, yes, and if there's any other questions on excess, please ask them now, because we have more than one person who is asking, can you please go over the concept of excess again?
Okay. When you go to, let's break it down differently. When you go to an auction, remember, the market is a continuous two-way auction process. When you go to the auction, there will more than likely be excess on both ends of the auction. For example, if the auctioneer attempts to get the bidding going for a valuable piece of art at $100,000, nobody will lift the bid at $100,000. So the auctioneer has to make it sound exciting. So he drops the price. He may drop the price to $99,500. That doesn't do anything. Then $99,000. All of a sudden, maybe he drops the price all the way down to $93,000. And all of a sudden at $93,000, somebody hits the bid. Now it goes from 93 to 94, 95, 96, 97, and it screams back up through the $100,000 level where nobody was interested the first time. But once the auction process got underway, so now what you have, from the 93,000 back up to say, 97 or 98,000, it moves very quickly. So once the market got underway, it left excess on the bottom because all of a sudden somebody bid it and everybody got crazy and away they went trying to buy it, and it moved very quickly. So that price had gotten too low. Now, as the auction starts higher, several things happen. As the market's moving higher and it's a good, strong auction, then you hear the auctioneer say, new bidder. New bidder means that higher prices are bringing in more activity, not cutting it off. Next thing you'll hear the auctioneer start to put in fillers. Who will give $100,000 or $105,000 for this wonderful piece of art from the such and such century? That tells you that the auction is slowing down. Eventually, the auction will go until the last bidder bid. When the last bidder bid, the auction is over. If in fact the auctioneer said, oh, I have another piece just like that, more than likely the price would drop very rapidly from what the first piece sold at. So you'd have excess on the top end, you'd have excess on the lower end. But the excess marks the beginning of one auction and the ending of another auction. Excess is one of the two most important concepts we deal with. Now, there will be times, and this is where I say, as we go through learning and understanding, it's necessary for us to teach things like the excess one step at a time. There will be times when all of a sudden there will be no excess. And as you get more experience, and we will introduce what may that tell you if there is no excess. A lot of times, what doesn't happen in a market is also more important than what actually did happen. So excess right now, it's just a very basic tool to start with. It is not everything. Okay, what else?
Okay, and that's coming through with a lot of the questions that I'm seeing here. So a question is, or one of the questions is, with this example of an excess high with single prints, does it make it more bullish or bearish? And we're getting other questions similar, like, so does excess equal tempo of trading? They're mixing
No.
you're mixing the concept of excess, which we're just trying to define basically as a basic by giving you this basic example so that you can identify what that looks like, and you're putting it with other concepts.
You're jumping way ahead and you're mixing and matching, and that's going to lead to a lot of trouble. Just to put it this way, it has nothing to do with tempo at this point. And tempo is something we talk about later. Right now, just keep it simple. When you're learning, learn it a piece at a time. Understand what the dot is and have a clear understanding of the dot. Then later, as you get more and more dots and you put them together, all of a sudden, the whole concept becomes clear. But you have to learn it's basic knowledge, which is what this is. Then it's mentorship to help you, understand the pieces and how they fit as you go. And it's that type of thing that you don't jump the gun. Okay, what else?
Okay, do we treat excess of say 2 ticks and 20 ticks in a similar way? For example, yesterday there's longer excess. So that's kind of like what Jim was referring to. We give you the definition, the technical definition, so we can start to build your knowledge, but you have to start from somewhere, and then we build upon that. So even though 2 ticks is the technical definition of excess, it doesn't necessarily mean that given a particular day or how it trades, that will be considered good quality excess. So you may have, excess, but it may not be quality excess. 20 ticks may be considered more of a quality excess than 2 ticks.
Or
Okay.
20 ticks may be far excessive. We'll get that later. 20 ticks may be far too much. May indicate something else. Don't rush it.
Depends on context, yes.
This is the second day of the primer. We're going over the basic concepts. You have to get a solid grip on the basic concepts before you start to expand them. Right now, it's simple definition. Excess, it takes 2 ticks to have excess. 4 or 5 ticks is better than 2. 15 or 20 is usually too much. So but there's no absolute numbers other than it takes 2 to start someplace. Okay, what else?
Okay. At what point do you consider excess to be excess? For instance, yesterday's D period. Hold on, let me bring up charts. Oops, mirror.
Say B period or D period?
Okay, you said D period. Hold on, let
D
me finish.
period was excess.
Okay, for instance, yesterday's D period formed excess. At what point during E period is that considered valid?
Okay, you're trying to make a science out of it. Very understandable. And sometimes, you're going to look at how the excess was made, and it is excess until it's taken out. Okay, and E period came up and tried to take it out and couldn't do it. So there's no nice line. You say, okay, this is the defining point. It is excess, and does it hold or doesn't it hold? And excess held, so that was excess. But there's no. I understand you want a better example. Well, when is it excess? When do I know? When do I use it to go short? You don't know that exactly. That's why it's a continuous two-way auction process, and it auctions from low to high and high to low, low to high and high to low, and comes back up and deep. And E period is auctioning from low to high, and it gets up there and it can't get it, so it left it. But again, I understand.
Okay, yeah, because they came back to say, I guess another way to state my prior question, do you have to wait for E period yesterday to close to consider the D period excess?
Absolutely not. But one of the things that we haven't talked about, that we will talk about later, is monitoring for continuation. So for example, if you think you have an excess high in D period and you go short the market, then as you're monitoring for continuation, if E period comes up and takes out the D period high, you no longer have excess, you may need to cover your short. If the E period comes up and doesn't take out the D period high, you still have excess and you may still have a valid short. Now there's other factors of consideration, but one of the most important things we get into as we get into the depth of the training we talk about is this concept of monitoring for continuation. And one of the things is, as your question is a great question, you may lean into the trade thinking you have excess, then you monitor to see if that excess holds. If the excess doesn't hold, now the auction's probably not over. Okay?
Okay. Okay. My software has an option to define the number of ticks per TPO letter. For example, if you use 4 ticks, for example, 1 point, you get a more compressed, easily viewable profile, especially the NQ. If you use 1 tick, it's it is an extremely elongated profile. You can hardly read the profile. Compressing it might mess with the excess assessment, or I'm assuming they mean details. What are your thoughts? Okay, so for the ES specifically, we are currently in 2 tick increments because of the range and the volatility. When volatility is not so high, we have our charts in 1 tick increments. We never go above 2 tick increments for the ES because you lose too much detail. If you're trading something like the NQ, my best suggestion is to observe and see what number of ticks you're comfortable with, You might want to use, up to 4 ticks for the NQ, but really it's preference and observation as to what you see with regards to references that will be the most accurate, and it can change, when volatility is higher or lower. Jim, you have anything to add to that?
Yeah, the one thing you don't want to do is you don't want to decide the tick so it fits your screen. Because there's some people do that sometimes, but if a market's really volatile, it just may not always fit on the screen. It may mean, and you may have to move it up and down, scroll up and down to see what's going on. But you don't want to condense it so much that you lose the bigger structural picture of what is going on. But generally, Jen gave you perfect advice. And you look at each thing you trade. If you trade a stock, you have to do the same thing. You've got to look at it and say, what seems to work with experience? And I've traded everything. I've traded gold, silver, soybeans, stocks in this. And what we do, we teach this from the ES, from the point of view of the ES. And because that's the most heavily traded market, the ES and the SPY are very heavily traded markets. And the other markets, you have to look to observe and make some adjustments. And like we say, we adjust on the ES. Right now, when volatility is over 20% on the VIX, which is the CBOE volatility index, I go to 2 ticks. When it's under 20, I go to 1. Now, if it's right around, 19, 20, 21, I don't know what I do. It just depends on what the market's doing. But again, you're trying to be practical in these decisions. But you don't want to condense it so much that you lose detail, okay?
Okay. I have more than one person with a similar question. Can excess occur more than once to the short or the long side? Another person asked, can we have second excess if a POC is wider?
The POC has nothing to do with excess. Excess is you can have excess in a couple of ways. For example, Jen, can you show a double distribution profile, please? Jen? Oh, I'm sorry,
Yes.
You're looking. I didn't realize.
No problem. I got it here.
All right. So on the profile you're looking at right here, you have excess on the top in A period. And you can only have one excess on the top. Now, when you get a double distribution, such as you have right here, and this market comes down and leaves a single prints in E period, that would be a second form of excess on that particular day and that particular profile. So you had excess on the high, which would be 1. You got the double distribution with left the single prints. Those single prints would be considered as excess, second excess on that day.
And I know that it can be hard to, absorb and remember all this. That's why reviewing these webinars to understand these concepts for the repetition will be key. Okay, let me see what else we got here. Okay. Can you clarify more details on time regulates opportunities when you were talking about time price opportunities, TPOs?
Okay, just think about it in a very logical sense. You have a house for sale. You put the house up for sale and you put the house up for sale at $300,000 and 4 or 5 days has gone by and nobody's looked at it. Guess what? You have to start thinking about adjusting that price. Nobody was interested in it. Instead of making a science out of this, think about it in terms of any kind of thing you're buying or selling. You go into a store, and for example, we're in the Christmas season. Now, all of a sudden, you're a thrifty person and it's after Christmas. And you go into the store after Christmas and things that didn't sell, the merchant has lowered the price in order to get rid of his Christmas inventory. Well, if all of a sudden that Christmas inventory, he lowers the price, it doesn't sell, guess what? He's got to lower it again. If it works the way it should work, it's after Christmas, he lowers the price to get rid of the inventory. It's 40% off. It should be gone in a second, gone very quickly. And if it's not gone very quickly, he's got a problem. He's got to lower the price again. Think about it if I look at this, trading is a business. Think about it in terms of running a small business. Now, I mean, it happens very quickly in the market, but the concepts are very much the same. I don't know if that answered the question or not. If not, come right back at me.
Okay. Okay, do we have lifetime access to the replays? No, you have access to the materials for 3 months after the course ends. So essentially, the course ends on the 9th, December 9th. So you will have access to the materials to review for 3 months after that. Okay, so definitely take advantage of that time to go over as many times as you can. Let me see here. Okay, yesterday you spoke about noise on the floor during floor trading. You also spoke about the pullback during the session. In case of a pullback, how would you relate that to the noise on the floor?
I mean, don't mix the two. I can't answer that question. It has to be more specific. All I was trying to do is just trying to give you a feel, for the same thing that happened on the floor happens off the floor. I can't. I try me with your question again because I can't get enough specifics to answer your question adequately. The biggest case I was making yesterday is that what happened on the floor traders had an advantage because they could hear if prices were going higher, for example, and the noise level kept going up. That was a pretty good idea that higher prices were bringing in more activity. You don't have noise when you're watching it on the screen. So you're watching it on the screen. If prices are going up and the volume's increasing and the activity is increasing, higher prices are bringing in more activity. If the market's going up and it's getting very slow, which we haven't talked about that portion yet, but it's called tempo, but if it gets to be very slow and the volume starts to dry up, then that's an indication that higher prices are cutting off activity. For example, Jen explained to you yesterday that red is the heaviest volume, pink is next, and white is the lowest volume. So as this market went up, the lowest volume would have been on the high. So if this was noise level, the noise level would have been lowest up here because as it went up, higher prices were cutting off activity, meaning the noise level on the floor would have died down. And here you got lower activity. So higher prices were bringing in less activity. That would have been, if you relate that to the floor, it would have been getting quieter. If higher prices were bringing in more activity, the noise level would have gone up. Okay, what else?
Okay. Having been with both at the floor and electronic trading from home or from the office, what additional transparency do office-based traders have sans the voice activity?
The first thing is those on the floor use their ears. And being off the floor, you didn't have privilege to that. Now, with screen-based trading, the power is in your ability to observe what is going on. So volume and the speed at which the market's going, you substitute that for the noise. For example, this would when the volume dries up, this substitutes for noise, and you see here. Now you also, and you're going to learn as we go on, we're going to talk about different references in the market. We're going to talk about half back from half period, 30-minute periods, half back for the day, and this is things you're going to learn as we go through the course that gives you an advantage, because it's easier, at least for me, it's easier for me to look and see what is going on without being distracted by all the noise on the floor. I found that it was on the floor, it was awfully easy to get caught up in the noise and lose track of the bigger picture. Now, there were some times that came to your advantage. Sometimes it came to your advantage because it alerted you very quickly. But overall, the transparency, I have more transparency of what's actually going on in the market by organizing it this way than I did by just standing on the floor. The eyes, if you take a look into the brain, I think it's well over 50% of the brain is one way or another dedicated to seeing. And the brain does an awful lot of work in helping you see what's going on in the market. Now, it's not seeing in the sense of a camera, because everything inside the head is chemical reaction, but so much of the brain is dedicated towards being able to see and observe what is in front of you. The number one, when I started one of the intensives, I said the start of this intensive, the operative word that I would like to focus on during this intensive, and intensive, you don't know, that's our ultimate course. It's like 4.5 weeks long. But I said the operative word is observation. You learn to observe. And it's like the story I tell is when I was with UBS, I had an additional assignment. An additional assignment was to recruit from Harvard, Yale, and the University of Rochester. When I first went out to interview students at those universities, I had a committee that selected people and resumes, and I'd look at the resumes and everything before I went out. And I did that a couple of times, and I said, no, I don't want any of that. That sometimes looking at all that information ahead of time blinded me or gave me a bias. I said, what I want to do, I want to go out, you give me, you committee, you select the people that you want me to talk to. You set up the schedule. I will go talk to those people, and I do not read the resumes before I go out, because I want to sit down and I want to observe that person. I want to observe that person without any biases. And that turned out to be a much better way to interview people. And a lot of the people that I interviewed over the years, I would see their name in the Wall Street Journal and et cetera. One of them actually ran for the Senate, lost by 12 votes, and it was Montana. But it's that ability and power to observe. That's what we want to work on more than anything. Okay?
Okay. Somebody asked if we could cover the one time framing concept again, since that was discussed. It will be part of a formal presentation, but to give an example, I guess, to try to go over that here since it's being asked. You guys can see my screen, correct? We're not on Jim's screen. I just want to be sure. Jim, you can see my screen, correct?
Yes.
Okay, so you heard Jim talk about the concept of one time framing down yesterday. So let me just show you. I just hopefully, and like I said, just remember if in GoToWebinar you can scroll over to get more detail, to enlarge if you want to. Just make sure you always put it back in case you feel like something's cut off, but it's not actually cut off on our screen. But anyway, you see from the high we had D. E period did not take out the D period high. And F did not take out the E period high. So, starting from here, we're one time framing lower. Let me get my mouse here to go. And I apologize that you won't be able to see this, but we're going to go. And an H, I, J. K did not take out the J period high, so we're still one time framing lower. And remember, in order to break one time framing, you need at least 2 ticks. You need to do it by at least 2 ticks, okay? And L, basically, so from D period onward, we one time framed lower yesterday.
And that's also in, we have 2 later presentations today that is also covered later today.
Right.
One
So
time framing, one time framing, it's just one way to get some idea of what's really going on in the market. And while we're here, while we're looking at this, the inside bar, and an inside bar means that the F period bar remained totally within the E period bar. That does not stop one time framing because we're talking one time framing lower. As Jen said, it didn't take out the high. We've said, and I don't know if we said it yesterday or not, but the 2 most important concepts we deal with are excess and balance. Balance can be 3 months of balance. It can be 2 weeks of balance. It can be 2 days of balance. It can be 1 day, or really tiny F period is another form of balance because it's all within the F period range. Each one of us has a different time frame. So this balance, when the market comes out of balance in G period, that is a legitimate short-term trade. When it comes out of, there's more things to consider, but excess and balance, the 2 most important concepts we deal with. And it was right in front of us, and we were talking about one time framing, so I just brought it up. Okay, so you see it's in front of you, it's real. And what I like when there is a trade from balance, I like it when the F period is a relatively narrow bar. And I can't tell you what narrow is, but it's going to be relatively narrow in relationship to the bar that it's inside. So in other words, it might be, relatively narrow to it's an inside bar relative to the E period. So I like it when the F period is substantially narrower in range, meaning from top to bottom, than is the bar next to it. So if the 2 are almost equal, then it doesn't interest me much.
Right. And I just want to clarify, because I know that some people may try to take this and commit it to memory. It's not just because it's F period or the period of F. It's about whichever period happens to be an inside bar. That's what he was describing. Okay. It's not specifically the F period because Jim said F. He specifically said F period. He likes it to be this. No. Okay. Just want to make sure I clarify that for people who are new. Let me see here. If there's any other questions on one time framing, like if it wasn't clear, please type that in now so that, before we move on to the next one. We'll be covering it again, but I just wanted to make sure because I know this is a concept that multiple people have issues with. So just because we covered it here, before.
What's important right now is you understand the mechanical definition of it. We're going to be talking more about one time framing today in one of 2 other sessions because it's got other relevance. Right now, this is the basic, you're just starting. You need the basic definitions down in order to expand the importance of those concepts as we go forward. Okay?
Okay. I have some extraneous, kind of out of scope questions here, Jim. Um, and I don't see any others that are definitely within scope as of right now. So I will I will ask some of these. Okay, an area I struggle with is anomalies, and I'm not sure if you covered that yesterday as I was traveling and I didn't get time to see the recorded
No, and I don't want to go
webinar.
into anomalies at this point.
Okay. Let me see here. Okay. Jim, you mentioned yesterday that one of the things traders have to deal with is a sudden reversal in the market's direction. Can you comment on how one can effectively prepare for and deal with those events? I think this is skipping ahead, but because of what happened yesterday.
What happens before always has a tremendous amount of relevance to what happens going forward. So for example, if this market is rallying higher in the morning, and as higher prices, we talked about this volume being light, up here, higher prices are cutting off activity. So the odds of the markets either stopping or reversing are increasing. If in fact prices were going higher and a higher volume was coming in, the chances of this stopping or reversing would be much less. So what has happened before always has some relationship to what may happen going forward. Now, it's not a science. I can come back and say it's artwork, but sometimes you get some announcement out of the blue. The other day, all of a sudden, when Chairman Powell was speaking, a lot of his remarks were pre-released and people knew what was going to be in there. But as he was speaking, all of a sudden, he brought up the idea of an early taper, and out of nowhere, the market cratered to the downside. So there, at that case, you have to be able to deal with it on the fly. There's no, it's not what led up to it. It was sudden, it came out of nowhere, and that happens all the time in markets. And that makes it very difficult. One of the things that makes short-term trading so difficult is you have to have the ability to make mental adjustments in the marketplace. So but the main thing to remember, what has happened before has a lot to do with the odds of what's going to happen going forward. As prices were going higher yesterday and the volume was drying up, the odds of continuation were lessening. Now, when you think about it, what happened? The market's going up. What are traders doing? They're getting long, they're getting long, they're getting long. When they're getting long, all of a sudden, they don't get anything to follow through the upside. All of a sudden, you get this panic selling to the other side, which is what happened yesterday. Then the market one time frame lower for the remainder of the day. So again, it's never one thing. You're looking at a lot of your preparation, and you looking and say, okay, what happened before has a lot to determine what happens going forward. And sometimes it's a sudden change. Excess is one of the two most important concepts we deal with. Once this market got excess and the E period came up and couldn't take out the excess, be very careful. Now, it's not always going to go straight down, but that was an indication that something had changed. It couldn't continue higher. But again, there's a lot of things going on. You're going to learn this as time goes on. Now, also remember, when I talk about what has happened before, has a lot to do with what happens going forward. And this is advanced because you're just starting. But remember, when we when we started talking yesterday morning, one of the first things that utterance out of my mouth, which I didn't mean to do because it was getting too far ahead of the course, But I just looked at it and I uttered how strung out the market was, how thin the market was going up. And I said, that looks like the structure of that looks like it's short covering. And short covering is classified as old business. Old business means people were short. And if people were short, if the market gets too short, that can add strength to a market on a short-term basis, because the only way you can cover a short is by buying. So if people start to panic and cover their shorts, meaning they're buying, you have to buy to cover your short, that can cause a market rally. Once that rally is over and that short inventory or that short covering is out of the way, it can weaken the market because you've removed the support. When there's a lot of shorts, that provides support to the market. You remove that support, it can weaken a market. So that was, I was, said that far too early, but it was there and it was right in front of us. So when I looked at that structure yesterday, that immediately alerted to me what had happened before, alerted me to the fact that this market could break. Now, I don't expect you to recognize what I'm talking about on day one, but that is one of the things as we go through this course. What we're doing in the primer, we're setting, it's an 8-day course. It sets some ideas of some of the concepts and some of the terms. By no means are you going to be able to be a successful trader just going through the primer. But what we're trying to do is give you an introduction to what we do, how we look at the market. It's not going to make you a trader. Matter of fact, it may make some of you worse, because it's going to be a lot of what we talked about. It's going to be in conflict to what you already know. And remember, I gave the example yesterday. Early in his career, when Tiger Woods was winning a lot of tournaments, he changed his grip. And when he changed his grip, he actually slid back for a few tournaments. Once the improvement from the grip was in place, he surged ahead to new highs. So, that concept, when you're learning this stuff early on, as we introduce these concepts, it may make it more difficult for you. It may create more cognitive dissonance than you already have. But all we're trying to do is just introduce some thinking to the process. And there are changes. When you're in the market, the value of the market profile, it gives the market structure. You build a house on good structure, or you build a house on weak structure. You want to go out to North Carolina and build on the ocean and build it flat to the ground, or you want to build it on piling so it can withstand, the sea level. A different structure. Different structures going to give you different results depending upon what the atmosphere is. And that's what we're talking about the market. Structure is important. Okay, so what happened, basic to your question, you have to learn to think in terms of odds and probabilities. That's where you get the edge. What has happened before changes the odds. So if this market is going up and it's too thin yesterday and the volume's drying up, the odds of upside continuation are decreasing. The odds of downward reversal are increasing. If in fact the market's going up and it's going up in a little more controlled manner, and you're getting a combination of short covering and new buying and higher volume, now the odds of upside continuation are increasing and the odds of downside movement are decreasing. So it's always what has happened before, and the key is going to be able to think in terms of probabilities. Okay, what else?
Is it the same rules for excess in the overnight and cash session?
No, it is not. As I've said yesterday, the overnight markets, a lot of times you will not have excess in the overnight markets. And the reason for that is there's the overnight markets on average have probably about 25% of the volume that you get during the day. Now, I haven't checked that number in a long time, but you get substantially less volume overnight. anytime you're doing something that is statistically based and odds, and they're not exact, but thinking in terms of, you need enough volume to give you a representative sample size. If the sample size isn't large enough, and the sample size overnight is not large enough to make the profile reliable. Remember, what the profile is, it's a distribution curve. A distribution curve is nothing more than a scientific way to organize data. Once the data is organized, it is easier to tease information from that organized data. But you need to have enough data to give it significance. And overnight volume, like I say, overall is about 25% of the daytime frame. So it's not reliable, and I do not rely on the overnight profile. We're going to talk about that. Overnight comes up, that discussion comes up in one of today's sessions, and we'll go further at that point.
Okay. How do we see whether price and value are traveling together or there is some abnormality?
Okay, we talked yesterday about when you're talking about the profile and the value area, and we're talking about the importance of the point of control. Is the point of control migrating higher? Volume, is it elongating? We didn't go to all those details, but we said you have to use your imagination to say, what is it going to take? It's going to take 2 ticks of range extension upward to raise the center of the profile by 1, or 2 ticks of range extension downward to lower it by 1. So as you're watching the profile and you're watching the market and you're seeing what's happening to the point of control, or the fairest price at which business is being conducted. Now, what is difficult is that price is going to move faster than value. Price will move the faster, value will move slower. So if the market's going sharply higher, then you have to make a determination, is value being pulled higher? And so, you're going to get, it's going to take time, and it's going to take, continuation to the upside. If all of a sudden you don't get that time and the market doesn't hold the upside, then you reduce the odds of value moving higher. But that is a determination you have to make. That is part of the art. One time framing we've talked about is one indication, if the market's doing well, going in a direction. There's no one single thing, but it's going to be volume. It's going to be volume. It's going to be it's in an orderly manner. And you're always looking to say, okay, if the market's going higher, price is going higher, you look at the profile and the value area, you say, okay, is the point of control going to be pulled higher? Is the profile elongating out, or is it becoming truncated? If the profile is becoming truncated, stubby on the top, and the market's going higher, it reduces the odds that you're going to get continuation. Nothing's perfect. It's always a series of odds, but it's continual. Successful trading is creative problem solving, and it also has a lot to do with being able to use your imagination to see ahead of time what is happening, to be able to be forward looking. Okay. And that's something, this is day one. You're not expected to know the answer to that on day one. That kind of thinking is good thinking, but it will develop as we go through the course.
Okay. If a TPO is too wide, then it seems that the 2 tick changes in price does not change the value with 1 tick. Is that correct?
I'm sorry, I don't understand the question.
They're talking about how value changes. So they're asking if a TPO is too wide, and will
Are we talking TOO or TWO?
TPOs. If we're too wide.
No. TWO wide or 200 wide.
Okay.
If we're reading too wide, reading from left to right. It was a misunderstanding. I wasn't sure what you meant by two. If you're too wide, reading from left to right, that means that the market is not doing a good job of moving directionally. Hello?
Yes. Yeah, they were just asking about the changing of value and how if
Yeah.
how it can change.
The wider the point of control or fairest price at which business is being conducted becomes, the lower the odds that value will change much from there.
Hopefully that clarified it. Let us know if it didn't. Okay, and here's a question that that I get similar questions like this. Basically trade related questions. You know, people ask things like they ask about a specific time of day, or should they wait, you know, after the first half hour to take a trade, things like that. Did you want to kind of just address that from a general perspective of, because, you know, Jim doesn't do trades based on a specific time of day or things like that. Trades are based on context and, you know, if the trade comes, you know, if the trade comes to you. And that's all based off of market generated information and your observation of the clues and judging the probabilities, you know, the context surrounding the situation.
There is a tremendous amount of misinformation out there, and some people tell you, don't trade during the first half hour or hour, don't trade during lunchtime. I mean, it's all baloney. Real traders trade when there's something to do in the market. I was in business one time with a guy that, you know, one of the Fortune 500, you know, richest people in the world type of thing, and he had 57 different phone numbers that he could be reached at. Real traders, if there's something to do any time of the day or night, they will be active in the market. Real traders and the people that really make the decisions, they're addicted to trading. So don't listen to anybody that tells you don't trade this time, don't trade another time. Now, we have some advice. There'll be some times when we tell you don't trade during the first hour or so or whatever. We don't bring it to a time element. But if the market opens, for example, in the center of yesterday's range, there's no real change, and we suggest that you may be better off just to let the market settle down first, because there's no real change. If it opens in the middle of yesterday's range, you're going to get a lot of chop. The market will chop up and down, and chop is very expensive. So we may tell you under those circumstances, you don't want to trade early. But again, another time the market opens and it's moving directionally up or down, get on the trade right now. It is not time dependent. It's situationally dependent, but not time dependent. People say, oh, well, don't trade during lunch hour in New York. Well, lunch hour in New York is not lunch hour in Hong Kong. It's not lunch hour in the Pacific Coast. Okay. But again, I wouldn't listen to that. You trade when the market tells you should trade.
Okay. And I think we got to all of the questions that we have for now.
Okay, and then we're back in, what are we back in, an hour? Hour and a half?
Yes. Yep. We're back in an hour and a few minutes.
Okay. All right. We will see you then. Thanks.
Okay, everybody. Thank you. Hope you found this helpful, and we'll see you at the next session. Bye-bye. Oh, and I realized that some people had emailed in that they had trouble getting into the webinar this morning. I apologize for that. There must have been an issue with GoToWebinar. Don't know what happened. I see that everybody who had written in was able to get in eventually, but it seems like the first few minutes or something like that, first 5 to 10 minutes, some people had trouble getting in. Hopefully you can just watch the recording and see what you missed. Okay. We are back at 9:30 a.m. Eastern time, so about an hour from now. Okay. Thank you.